You study technical charts and stuff. Another thing I do in depth, the next wave would have to be, the third wave is usually the strongest. The next wave down, you get a one wave down, a two wave bounce. We're in that two wave bounce, rolling over into a third wave. The third wave is larger than the first wave, and that's going to take us into 58%, 60% down stocks. Then everybody's going to know we're in trouble. And then the Fed say, we need to print 20 trillion instead of 10. I think people are finally going to say, sorry, you did that already.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with LibertyInFinance.com. And with us today, a very special guest, best-selling author Harry Dent of the H.S. Dent Forecasts. Harry, thank you so much for joining us today.
Yeah, nice to be here, Elijah.
Well, it's great to have you. And it's very interesting. Your forecasts in the past and right now, people have said that you've been too bullish in the past. Now they're saying you're being too bearish. I wanted to get your perspective on what is happening right now in the financial system. With the banking system right now, we're seeing a lot of shocks. 3 banks in the U.S. have collapsed. Credit Suisse is being taken over by UBS. First Republic Bank was having issues. What is your take on that, and how does it play into your overall extremely bearish forecast for the markets here?
Okay, yeah. Let me start out with one comment, because I used to get criticized, especially in the late 80s and early 90s, for being way too bullish. They thought America was done, Asia, Japan was going to take over the world, and we were, be slaves to them. And now, after being the most bullish guy in history, even predicting a Dow of 35,000 way back then before this thing would peak, which people just thought was stratospheric. Now it's like, you're too bearish. Look, don't blame me for the greatest boom and bubble in history, and great bubbles, without any exceptions, always crash bigger than normal bull markets. So in fact, I had to, in the early 2000s, update my demographic and cycle work for really studying bubbles when I realized, oh my gosh, that 95 to 2000 run, that was a bubble like 25 to 29. And my research says it's not over yet. The baby boom is going to spend much longer. So don't blame me for the most extraordinary times in history. And you can't have a great boom without a great bust. So we shouldn't be complaining about this. And America is still the strongest of the developed countries in the world. And we're seeing our Asian competitors, Korea, Japan, and emerging China, kind of peak here and leave the way for the rest of Asia, Southeast Asia, and India to increasingly dominate the next boom. So first point is my specialty was in the beginning, not just cycles, but I discovered demographics, that people are predictable. And in the United States has the best data on this. The Bureau of Labor Statistics, they track, thousands of people every year, exactly what we spend when we invest, when we do anything. We buy, startup homes, trade up homes, cars, you name it, potato chips. I can tell people when the average household spends the most money on potato chips as if it mattered, age 42. Why 42? The average kid's born to them at 28, and they're eating the most calories and junk food at 14. So what I do is I make that silly example to show how predictable things are, not just macro, when the spending peaks for the typical developed world, Europe, US, Japan family at 46 to 47, and then declines, but even down to potato chips or motorcycles or first home buying, vacation travel, anything you want to look at. There's 600 categories tracked regularly by the US Bureau of Labor. And I know when people spend pretty much on everything, and economists somehow didn't discover this and somehow don't think it's that important because they think, it's all about fiscal and monetary policy. Well, what we have now is desperate very desperate monetary policy since 2009, when I predicted not then, but 20 some years in advance in the early to mid 80s, that this baby boom driven boom from 83 would peak in 2007, and we would enter a slowing period after that, 2008 forward into right around now, 2022, 23. I predicted that way back. The problem is governments panicked when it looked like we were heading into the next Great Depression. And by the way, Ben Bernanke was the Fed chairman then, and his thesis was the Great Depression. So he was the first one to say, holy smokes, no depression on our watch. And they've been printing money. They thought, oh, just a year or two after 2009, we'll be back to normal. No, my stat says there is no getting back to normal until the next generation, the millennial generation, starts their spending boom from late 2024 into late 2037, just like I predicted late 82 to late 2007 for the baby boom. So in between, we've had this massive money printing, which has created a massive second stock bubble and tech bubble to that first one that peaked in 2000, then the overall peak in 2007. That was right in line with the demographic cycle. But this panic and massive money printing, in fact, just since COVID, $5 trillion in new monetary stimulus from the Fed and $5 trillion committed to fiscal expansion, which is even more inflationary. And surprise, surprise, Elijah, we have suddenly gone from 1% to 2% inflation to 9.1% inflation. Oh, and now they have to tighten. Here's the point. These people shouldn't be running our economy, a bunch of academic people who've never run a business. So, I mean, this is insane that economists, and particularly the Federal Reserve, thinks it's their role to keep our economy growing and to fight off recessions. Recessions are just as important as booms are to the economy. And just like we're awake about 16, 17 hours a day and asleep 6 to 8, the economy booms for 25 to 26 years, like 42 to 68, and then declines from 69 into 82 when generations spin and then slow till the next comes, and all other types of cycles like this. So the economy needs to grow. It also needs recessions. The recessions clear out the dead wood. The smartest people in the world are park rangers. When they get forest fires, 9 out of 10 of them, they don't fight them unless they're going to take down the whole forest, because they clear out the underbrush and make the whole system healthy. Recessions are like common colds and other things in forest fires burning. They make us healthier. And Federal Reserve and government officials, nobody wants a recession on their watch, so they fight recessions, which is the stupidest thing you can do. And so this is not going to work out well. We have overstimulated our economy since 2009. Stocks have gone to massive new highs when they should have drifted lower over 12, 13, 14 years. And now we're going to have the big crash at the end. Remember, we have to go all the way back 2 generations and 2 technology cycles to see a bubble boom like this in the roaring 20s, a massive crash, 25% unemployment, 89% down in stocks in the early 30s to wash all out that bubble. This is the first bubble economy since then. Governments have created a second bubble on top of the first one that would have peaked, a little earlier in real estate in 2007 for the overall economy. And so now we have second major bubble in real estate, second major bubble in stocks, and it's going to have to come down to reality, shake out all types of bad debt. We have record zombie companies. These are companies that are barely alive only by not paying their debt service. Okay, so those are the zombie companies. All of these on records. We need the economy to shake out this stuff for a couple of years, and then we can have the next boom with millennials. If we don't let this happen, and the truth is, I think it's already now happening anyway, finally, because the Fed slipped up here, the millennials aren't going to have much of a boom because they're going to be carrying all the baby boom debts and zombie companies with them, and it'll compromise the economy. So this may sound funny, Elijah. I feel like this downturn is exactly what the economy needs, and it's been put off way too long. If we'd have done this in if the 2008 downturn had just lasted another year, a little more, been more like the early 30s, clean out all the bad debts and zombie companies, we would be in a much healthier economy now and not need a bigger crash than ever. We're going to see the crash of our lifetime. I think it just started. November 22nd for the NASDAQ last year, January 4th, 2022. The year 2020, January 4th, 2022 for the S&P. That was the last major index to peak, and they've been peaking for a year, coming out all around the world. When you see one index peak around the world over a period of time, that is not a short-term correction coming. That is a major long-term top. So that's been a confirmation for me. I also told my subscribers that I won't know that this is really a top until we see what every bubble has seen, a minimum 28% first crash, maximum 50%, And so we did finally get that. We got 28% in the S&P. We got 38% now in the NASDAQ. That says to me, 90-some% chance this bubble has peaked forever. And now we're bouncing for 5 months. It's about as long as any major bounces, and as long as the one after the first 29 crash started. This bounce, I think, is near its end. And in the next month or two, we're going to see stocks break to new lows. And my magic number, Elijah, is very simple. 10. I'm tracking the NASDAQ because it's the more bubbly of the major indexes and leading this whole thing up and down the bubble. 10,088 is the line in the sand. We break below that. I think it's about 9% below where we are now, something like that. We break that. A next wave down is going to be at least as big as the first wave, probably bigger. We're going to go back to the 2020 lows, which will put stocks, the NASDAQ down 59%, the S&P down 53%. And then people will know first, the government was not able to prevent this in the end because they got caught tightening because they overreacted to COVID, which was a natural virus. Why would you print $10 trillion of stimulus to fight a virus that's going to go away on its own, just like the influenza did in 1918, 20 anyway? That's where they blew it. They kept stimulating, and they keep managing. They lost control by overreacting to COVID and forced themselves to tighten. Now they can't just pull back and loosen this quick. So they're tightening a little less, but they're still tightening. And I'm telling you, the economy cannot take this because the fundamentals I study, which are the best in the world, the demographic trends, the most predictable fundamental trends of when people are going to spend money in any country in the world, U.S. and Europe, they are peaking. They are down at their lowest point now. So the economy cannot take this tightening. And when it does fall, and I think it's going to fall faster, and this next wave in stocks, again, you study technical charts and stuff. Another thing I do in depth, the next wave would have to be, the third wave is usually the strongest. The next wave down, you get a one wave down, a two wave bounce. We're in that two wave bounce, rolling over into a third wave. The third wave is larger than the first wave, and that's going to take us into 58%, 60% down stocks. Then everybody's going to know we're in trouble. And then the Fed say, we need to print 20 trillion instead of 10. I think people are finally going to say, sorry, you did that already. And my greatest hope, what will make all of this craziness a positive long term, is that we never let central banks run the economy again. What did Adam Smith say? He was the inventor of free market capitalism in the late 1700s, okay? He said, the invisible hand is the secret, a bottoms-up economy where businesses and consumers just vote and do their thing, and it grows by itself. Government should keep hands off as much as possible. Well, what happened in the 2008 downturn, which was predictable, nothing wrong with the economy. I predicted it decades, as I said in advance, not just a couple of years because stocks were overvalued. It was due to happen. They panicked and took over the economy like they're smarter than God in the free markets. And that's going to go down, I hope, is the biggest mistake in history, and get the Federal Reserve and central banks around the world out of the running the economy business and just be there in emergencies when money supply, when you really have a real emergency, okay? So I think that's the good that comes out of this. But I'm telling investors, just because stocks are down this much, if you missed it so far, this has been a darn good bounce. So you haven't missed as much as you thought. This is the last chance to get out of stocks, and real estate clams up much faster than stocks, and you just can't even sell real estate at some point. If you got real estate, a second house you don't really need, or you're thinking as an aging baby boomer of downsizing from your big house, now the kids are left to a smaller house, do it now. And if you can, rent for a while because real estate takes the longest to turn around. In the last crash, before the government cut it off about a year short, it took, stocks turned around in a little over a year and a half. Real estate took 6 years to bottom. So real estate is where you really have to watch it. If you don't love it and going to live it for life, I actually bought a house in Puerto Rico because it was such a bargain. And it could go down 40% and I would still be 40% ahead. And I just bought it 3 years ago. Okay. So I actually did something I told my subscribers not, but I got a really good deal in Puerto Rico. Is a different market because Americans are moving here for tax. Rich Americans, average 20 million net worth, are the immigrants coming into Puerto Rico from America for this tax program to support Puerto Rico. So I don't think my house will go down nearly as much. And by the way, I'm predicting, and this will sound high until you remember last time, housing, the average house went down 34% in the last downturn, 2008 crisis, okay? I'm just predicting 50% this time. That is going to be the biggest shock. Stocks go down and come back quicker. Housing doesn't. And I've got a quote in one of my newsletters said, real estate will never be the same after this peak because the millennials, the first time a smaller generation has followed a larger in all of modern history. And this is around the developed world. And China is the first emerging country to have that happen. They will never see their demographic trends weaken from now on. And then successive emerging countries will see this happen over decades. So demographics is predictable. Demographics say we're way, way, way overvalued. We were already overvalued in 2007. Now with all this stimulus, we're aware of it. Get out of the way. Sell any unnecessary real estate, and absolutely on this bounce, which is very close to over, if not over in February, already starting to head down. Get out of stocks now. The next wave is going to be even more painful, and that won't even be the bottom. Sorry I took so long.
No, it's all good. And it sounds like you're really looking for things to accelerate from here. Your perspective on the issues in the banking system, is that just going to be a kind of a further catalyst, or is that just going to speed the crash up from here?
Okay, that is a sign. When you push interest rates 2 to 3 percentage points below normal value, people speculate more, businesses expand more, people buy a bigger house than they would have, they get a bigger mortgage, all these things. All they did was leverage up an already bubbly economy to save the crash of the last bubble. Again, we'd have just gone into mid 2010 instead of early 2009 in that last crash, and stocks would have gone down the normal 80% in a major top instead of 57%, and housing would have gone down 50% instead of 34%. We would have been over this big correction and put the greatest financial asset bubble in history, and globally and in all sectors. Even 29 was not as global and certainly wasn't all sectors. Okay, real estate wasn't even that bubbly in the roaring 20s because nobody could get a damn loan. 5-year loans with 50% down. Try speculating on that. Okay, well, different world today. So everything's in a bubble. Real estate, commodities, gold is in a bubble. Peter Schiff and people saying gold is the solution. Gold has had a bigger bubble than stocks. Gold will, as it did in 2008, hold up as it's doing now in the early stages of this stock crash. And then it will go down and join everything else in the second half of this downturn. So gold is not the savior. What is, and proven by the early 30s and the 2008-9 crash, the longest term, safest U.S. Treasury bonds. 30-year bonds are the best. The longer the duration, the more that deflation is leveraged. Deflation brings all financial assets down. The only thing that goes up is the highest quality bonds, i.e. the 10 and 30-year U.S. Treasury, the best, and the AAA corporate bonds. But I'd still rather, why buy a 20-year AAA corporate bond when I can buy a 30-year Treasury bond that is even safer, longer duration, and more leverage? These bonds, mark my words in this, can end up going from their recent bottoms up 60 to 80% in the crash of a lifetime, almost as much as stocks go down, because they're the only safe haven. And gold, even though it might yet get a little over 2,000, will probably end up at 1,000, down 50%. So not the safe haven, not the worst place to be right now, but if you see the economy start to weaken, I'm telling people get out of the gold as well. And if you got to hold one thing, hold that. But I think gold will go down 50%.
It does seem like when we see the stock market crash and other financial assets crash, precious metals do fall significantly as well. We often see a rebound quite quickly in precious metals. What is your forecast for gold and silver after we see this crash? And it sounds like you're looking for gold to crash quite significantly. If it hits 1,000, where does it go from there?
Okay, that's a great question, because first of all, if gold does crash about the 50% I'm looking for, from around 2,000-ish, maybe 2,200, it's got some resistance at 22, 2050 if it has a late stage rally, but it should end up closer to 1,000. Okay, so that's a 50% or so drop. Silver always drops more; it'll be down 70% or more. In the next boom, not because of monetary reasons, for the first time in history, I think gold will have its greatest long-term boom for one reason. Emerging countries, particularly China, and more so India, which is going to be the next China. China, over the last 40 years, went from emerging country to borderline developed country in a matter of decades. India is going to do the same thing, and it's got stronger population, stronger demographic trends, doesn't have the huge debt problems, and centralized government. It is a democracy, for crying out loud. I mean, the other good thing out of this China thing would be you finally break this stupid ass Chinese communist government, which is so outdated, it's ridiculous. And they're holding on to power by what? Pumping up the economy, telling builders to build, 22% homes and offices empty, and thinking that's okay. They're doing this to keep their people happy so they don't overthrow them. So I think you're going to see major changes in politics. India and Southeast Asia will lead this boom out of it. The tech sector in the United States will also lead, because we're still dominant there. So in the downturn, when things collapse, I'd want to be buying Asian funds, Southeast Asia, India dominated. And I'm researching those already, but we're a year or two away from that. And I'd be buying the NASDAQ and tech stocks in the US again, and gold as a diversifier. So because gold, nobody likes gold more than Indians. People who are poor, but it's a way to show off a little wealth. Okay. So gold, I think gold will not go up because of financial crisis stuff, because it didn't prove to be that safe haven in 2008-9. It's going to prove less so this time. It's going to be driven by the growth of India and Southeast Asia, where people just love gold more than we do, and spend a higher percentage of their money on gold jewelry and gold stuff to show off a little bit. So I think gold could go to 3,000 to 5,000. In that next boom from 2024-5 into 2037 for the U.S. and way beyond that in the rest of the world. So that's when I would buy gold. But now I'd still look and say, wait a minute, if I had to buy one thing, would I buy Asian stocks or the NASDAQ or gold? I'd buy Asian stocks or the NASDAQ, because they're going to do even better. But gold, of the commodity sector, is a great diversifier. And so gold would be a good thing to have in your portfolio, or a commodity index. But I'd say gold would be even better, because the Indian, I'm just telling you, I've been to India, second only to Australia as a country I've spent time in. They like gold over there. They just like gold. I mean, they're not buying it as an investment. They're buying it in little ways to show off. They wear jewelry in places we don't even think of, okay? Toes, okay? They have jewelry on their toes. And it's gold.
Now, another asset that you have said that really could be the digital standard of money in the future is Bitcoin and the cryptocurrency sector. I wanted to get your perspective on that. Do you see that crashing as well, and there being a buying opportunity at the bottom of the crash for the cryptocurrency sector?
That's a super question. And this is the most astounding. It is the bubble of the bubbles here. Okay. When I find the last few years, I see this bubble in Bitcoin building, everybody's saying, oh, it's a hoax. And other people saying it's the whole new thing and it's going to change the world and the greatest thing in history. It's both. Okay. It is the next big thing. And what I compare it to, you have to compare likes to like. I'm comparing the crypto space, and Bitcoin is the leader, to the .com space, which was the internet index, dominated the internet index in the 90s bubble, and Amazon the leader. So I look at Amazon and Bitcoin, and you know what? They're doing the same exact thing. And if I project Bitcoin to continue to follow Amazon's crash, Amazon went from 6 in 98 to 136 at the 2000 tech bubble peak, back to 6 by 2002, okay? 95% crash. I'm projecting Bitcoin to do the same thing from 69,000 to 3 to 4,000 bottom, and then go to 500,000 to 1 million. In fact, my best target, 780,000 by 2037 to 40. So Bitcoin is the next big thing. It's not coins. The coins are nothing. Okay, that's not the point. It's a guy at my own conference years ago, before COVID, said it, and that's when I really got it. He said it's the digitization of all financial assets and money. So step back. What was the last big thing? The internet digitized information and made it easily accessed to everybody. That's what the internet did. So this is the internet of money instead of the internet of information. And what the light bulb went off in my head, because I know a number I bet no economist you talk to knows, the total financial assets in the world. It's the biggest single financial number. It was 572 trillion several years ago. It would be about 600 trillion at this time. 600 trillion in financial assets that gets made far more efficient and flexible and tradable and all this sort of stuff and dividable by cryptocurrencies. It's the digitization of these. It's not all these stupid coins, which is what coins are. And this was a big innovation, by the way, except that it's got overdone. They're just a way to go public at almost no expense. You create a coin and then you throw it on Coinbase and people can trade it. And you got an IPO that costs you almost nothing. Wow. Okay, you know what the problem with that? We have, last I heard, 40,000 coins out there. Everybody did this. So any idiot could start a company, create a coin around it and be tradable. Okay. Well, those are going to get flushed out. Okay. What will be here with Bitcoin? I see Bitcoin as the leader and not very functional, becoming the standard. Bitcoin gets up to 500,000 to 1 million in value following the Amazon example. That's all I'm doing, picking something very similar. In that value, it is now worth more than all the gold in the world and can grow with global growth. And it becomes the gold standard, the standard for the new digital monetary system. And then there's a lot of crypto companies like Ethereum. Ethereum spawns off applications. Okay, well, that's what you need. Financial applications in this crypto code and stuff. So I don't understand it altogether, but I know the next big thing when I see it because it totally tracks Amazon and the internet index in the past on a 22-year lag. And why is that important? My other big cycle, other than demographics, new generations come on about every 40 years. It's more like 39 to be exact. Technology cycles are 45 years, and within every technology cycle, you get two big waves of innovation, okay? Automobiles and then all of the automatic features on them in the next boom, okay? So you had the internet and now crypto. That's the two phases of this 45-year cycle. So what am I doing? Comparing the leaders of crypto with the leaders like Amazon of the internet bubble. And that's what tells me Bitcoin could be 780,000 within 15 years. Wow. So will I buy it at 3 to 4,000 if it gets that? And that's just my target if it crashes as much as Amazon did. And it's already gotten to 16 when everybody said couldn't go under 20. Well, I say it doesn't stop there. My closest expert here, Michael Turpin, he is one of the biggest guys behind the scenes in crypto. He sees it going to 10 to 11. So that's the minimum. So this is not a bottom from what I see in Bitcoin and crypto. The question is, does it go down to 10 to 11? And I've heard too many forecasts for that to be credible. I say it goes to 3 to 4. And then, man, people are going to say it's a hoax. That's when I want to buy. I will buy. I haven't been playing Bitcoin much. I will buy it then because I think it will lead. Nothing will go up faster. No way Amazon's going to, in the next boom, is going to outstrip Bitcoin. If this is right and it is the next big thing. And again, I only look, is it acting like the last big thing? And it is exactly. Amazon and Bitcoin are tracing. You couldn't have a closer. So that gives me more confidence in that view.
Now, we've been focusing on the long-term picture here, the next year, couple of years here. Before we let you go, if we could get a quick take from you on the Fed meeting, the short term here this week. What do you anticipate coming from it this week?
It seems like the easiest thing here. They could go zero. 50's off the table now, because of this recent banking problems. I think they'll go 25. I think, and for me, that sounds like, oh, it's not much. No, they're still keeping the edge towards tightening. The longer they tighten, the more this weak demographic fundamentals is going to show itself. So I'm actually rooting for them not to go to zero. I want them to keep raising a little bit. So 25 is better than 50. Okay. So I think that's the most likely thing. And if they go zero, stocks are going to rally. I think they're going to rally maybe a little bit, but I think stocks are going to rally, particularly if they happen to go to zero. And I don't think it'll last. And so I'm looking for 13. From the bottom we've seen, the ideal bounce. So we had a one wave down, let's call it. We're in a two-wave bounce. The ideal target for that would be 13,186 on NASDAQ. Does that mean that's going to happen? No. But if we get to 13,186, I am buying SQQQ triple short and going to short this thing because the third wave should be stronger, or at least as strong and probably stronger than the first wave, and that's going to be a huge move. So that's what I see happening. We're near the end of this second wave bounce. It could have already peaked in February and we're heading down, or we could go up one more time as high as 13,186 on NASDAQ. And then we see a big or bigger crash than the one in 2022. And next thing you know, the stock market's down 58 to 60%. And we are definitely going to have a recession and people are scared to death and realize the experts were wrong again.
Harry, we really appreciate your time and insights today. If our viewers are interested in learning more, where can they find you?
Okay, yeah, very simple. HarryDent.com. I have a free weekly newsletter. My partner and I each give you a one-page article with a chart of something every week. You're going to get a couple articles a week, and that's for free. That's to get to know us. I also have a monthly newsletter, the HS Dent Forecast. And you can sign up for that as well on harrydent.com. But you can't lose getting on the free newsletter. People need a counter opinion at this time because too many people are just kind of cheerleaders rooting for the economy to go on. No, the worst thing we can do is print too much money and create even more of a bubbles. We should the sooner we get this bubble out of the way and do it sanely, the quicker we can go back and have a good economy for our poor millennial children, all you baby boomers out there, okay? We are killing their boom by not cleaning up our own debts and bubbles that we created as baby boomers and our central banks created in their panic to have the ideal economy with no recessions. No recessions is not the ideal economy. It is a dead economy, and if you don't believe that, ask the Japanese, who've been going sideways with near zero growth and inflation for 30-some years.
Fantastic. Well, harrydent.com is the place to go. We'll put the link in the description of this video. Go sign up for the free newsletter. You can't lose on that. Harry, once again, thank you so much for your time, and God bless.
Okay, thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.